The Vox Markets Podcast with Justin Waite. Nothing in this podcast is intended as investment advice, and the people in this podcast may hold positions in the stocks they talk about. Do not buy anything based solely on a tip or recommendation. Please do your own research.
Welcome to the podcast on Friday, the 11th of December 2020. On the podcast today, Tony Swiericzuk, Chief Executive Officer of SO4, explains how their equity placing enables the financial close on their £138 million debt facility. Also on the podcast, Harvey Sinclair, CEO of eEnergy, talks about how the proposed acquisition of Beond Group plays to their strategy of becoming a broader energy services company. And Paul Hill, full-time investor and equity analyst, gives his view on the market and also covers Northbridge Industrial Services, Proactis and Kromek companies. Plus, Russ Mould, investment director at stockbroker AGBL, talks about AirBnB, as its valuation shot over $100 billion yesterday on its Wall Street debut. And at the end of the podcast, I have two lists for you. The top 5 most followed companies on Vox Markets in the last 24 hours, and the top 5 most liked and most read RNSs as well. Plus, don't forget, there's plenty of content right there at voxmarkets.co.uk. In fact, there's an article on eEnergy. There's one on Meet Mark Austin, Chief Operating Officer and Senior Geologist of Alba, Mineral Resources, of course. And there's plenty. In fact, there's a video there. Paul's face is staring. Paul Hill staring at me. Trellis Health and EKF Diagnostics Company discuss their IPO plans for 2021. So lots of stuff there. And of course, our COVID-19 index is there. Where biggest riser today is Omega Diagnostics, and it's been falling quite a bit of late, so hopefully maybe finding a bottom. Who knows? 51 pence there, 8.5%. And down, biggest fall of the day is N4 Pharma. It's down 5.7% to 8.3 pence. Check all that out at voxmarkets.co.uk.
Vox Markets is an online community of investors that runs a free mobile and desktop platform that allows you to track news and updates about any UK-listed company, offering RNS push notifications, detailed charts, pricing data, and much more. Find out more at voxmarkets.co.uk/app.
And joining me on the podcast right now is Tony Swiericzuk, CEO of SO4, ticker there SO4. Tony, thanks for joining me.
Thanks for having me back, Justin.
Yeah, well, it's been a busy few weeks for you, and I've got a few questions here from investors, because today you've announced, of course, fundraising and lifting of suspension on the ASX, which is voluntary suspension, of course, there. So let's get into it. I'm sure lots of people know about the company. So last time you were on, I think you were saying your plan was never to have to raise any more funds again via equity. You were fully funded for the Lakeway production there. But you've also obviously done another fundraise. So what happened? What changed then, Tony? Can you explain that?
Yes, sure, Justin. That was the plan back in August. Obviously, when we did the fully funding piece and came out with that. Between now and then, or now and a few weeks ago, there's been a couple of fundamental changes, and the easiest one to explain is foreign exchange. So the banking model, or the base case financial model, has a 0.68 or a 68 cent FX in there. We've looked at that now being at 74 cents, and in the last couple of days, it's even gone higher than that. So it's a bit of a moving feast in the FX world at the moment with the Australian and US dollar, because we are drawing US dollar debt. So as I've explained this to people, I sort of pitched that around that 11 to 12 million Aussie dollar gap, just purely from FX. The second fundamental thing that changed, we had a solution in place to cover the bank guarantee for the APA gas pipeline, and a few weeks ago, that solution was withdrawn, so we had to act very quickly. We pivoted directly to our export finance here in Australia, and we have worked very positively with them in the last few weeks, but we just can't get that government credit agency over the line in time to support the speed at which the project is being executed. So we've had to hold the schedule, go and equity back that gas pipeline bank guarantee, and that's another 18 Aussie million dollars. So between the two, that's 30 Aussie million dollars. That you can see referenced there as a CP to get that first tranche, 105 million US drawdown triggered. Now, while we were going back, we decided that we would fully shake this thing down and de-risk it, because we don't want to go back again, of course. So we ran all sorts of different model scenarios. Our proposal for our final approvals has been through the EPA board meeting yesterday. So that's gone quite well, very well. That's all I'll say on that one. And that now, from the timeline here, places us in a period next year that has exposure to a government election. So we have a government election here in 13 March next year. So there's caretaker periods and reforming of governments. So we've run a couple of different model scenarios there and how that could play out in the ministerial approvals or final signatures for our final EPA approvals to build the final pond trains. Mm-hmm. So we've basically upsized that raise to basically counter what we've referred to, I think it is the ramp up model versus actual in that the announcement. So that's that additional delta in the raise, and we refer to it as that working capital. We're very, very slim on working capital all the way through this modelling. So they're the sort of major fundamental points that make up what we've just gone out and raised, and further just de-risk this ramp up period.
Understood. And so so where are you now? Do you need to raise again via equity, or are you now sort of, like I said, fully funded there, or is there a condition there? Because there's a condition. They said you're drawing down 105 million. So what's the condition for the drawdown of the final tranche?
Yep. So we've drawing down as much as we can up front, 105. There's still 33 million US, and they're really the CP on that is a standard market condition CP, and that's just a final cost to complete review before you take that final tranche down, and that's very normal with debt, project financing. The good thing is we've only got two tranches, so we'll crystallise that FX risk very quickly on the 18th of December, Friday. This time next week, and by pulling a lion's share, a majority down of that total 138 into our bank account.
Yeah. And someone said, they're going to raise another 30 million. Is that the case or not?
No. So this now, this now releases the 138 million US facility that's being supported by Taurus and Clean Energy Finance Corporation. So no, I don't intend on having to raise any more in the near future, and that's why we've walked this one up now to be certain. As certain as we can at this point in time.
Excellent. So as far as you're concerned, so production is still on track for March and start selling in April. And someone kept, quite a few questions coming to me, and someone said, potash prices have taken a hammering. Of course, dollar strengthening. Does that, the currency or price of potash going down or whatever, if it's changed, does that affect your EBITDA levels?
No, I'll start with the first question answer. Are we on schedule? Yes, the project is now 80% complete. As I sit here and talk to you, we've got over 400 people involved in the construction process on site. The piece here is that this is a whole financing, repair piece that we had to go forward with. It's got nothing to do with the technicals of the project. They're the same. The markets, off-takers is the same. Construction project execution is flying along. We'll be commissioning in February next year. I'm guiding now that first product will be March, and we're sort of saying we'll get that first sale away in April. If we can get away earlier, we will. So all of that's on plan. Nothing's changed in that space at all. So to the second part of the question there, I think you said SOP pricing. SOP pricing is very strong at the moment. So, we're seeing increased prices coming out of China at the moment. So that's quite good. Northwest Europe benchmark between CRU, Argus and Green Markets, the three analyst firms that sort of cover the SOP pricing for seaborne trade. They've got that Northwest Europe benchmark sitting around that 435 to 475 euro between the three of them, which is about a 520 to 550 US for standard SOP, of which we've had to get obviously independent expert advice for the funding syndicates, review and due diligence, and being guided, we will at least receive a 10% premium to those prices. So it's actually quite different. It's quite strong, the pricing. Yeah. We're very resilient through the COVID period, and we're not seeing any down pressure at all.
Yeah. And as far as currency is concerned, will that affect anything, the model at all?
Oh, well, it's US debt, so the currency does affect, but we are crystallising 105 of the 138 next Friday with the 18 December drawdown. So we basically wipe out whatever that percentage is, 75, 80% of that risk exposure next Friday.
Okay, cool. So your final thoughts, Sonny? It's been a sort of, I've said before, the road of business, it's never run smoothly, does it, business? There's always a few hiccups in the road. But what's your thoughts now? Do you think you're over most of the hurdles and it's a home run now?
It's been interesting. I joke that everything bar the kitchen sink's come my way at the moment. So, we've had the COVID year, which we've got through. Construction sort of is on schedule, on budget in terms of a construction project. We've had to go back out, unfortunately, now to cover what I've explained as being foreign exchange and a bank guarantee, and then some modelled schedule scenarios through our ramp-up period next year, as we go through a state government election. So these are all things that are sort of separate to that project execution piece that is happening very successfully. So look, I think we're good. There's a lot of money coming into the bank account. That cash flow forecast looking forward with this money takes us, well out in Q2 next year, calendar year. So, what we're focused on now is absolutely bringing this home, getting this plant commissioned and getting it ramped up and producing premium SOP.
Yeah, excellent. And is there any sort of questions you've had from investors, over and over again, maybe, this same kind of question that you haven't covered on this podcast, you think?
No, I've pretty much run the same spiel and the same story. It's consistent, and that message is that in terms of project execution, project delivery, everything's on track. It's all happening. We've had to sort of come over here and tidy up a few loose ends in the financing package. I won't repeat that, but it's all laser focused now on getting this thing over the line and delivered, and getting that premium SOP out into the market to our customers who are desperately waiting for it.
Yeah, marvellous stuff. Well, Tony, maybe it's a good opportunity for some people to add you to their watch list. So give us those 3 T's again, if you could, for people who are not following the story, those three reasons to hit that follow button on your page and add you to their watch list, please.
Sure, it's been a little while, but those 3 T's are still well in the head. So the thematics, Justin, the first T, thematics, great, tailwinds here in terms of the growing populations and the shifting wealths and shifting diets and those food demands that are out there. It's a very clean, green produced premium fertilizer. It's saltwater and sunshine that makes fertilizer to feed people. So beautiful ESG thematic there, and that's what attracted me big time to this at the beginning. That's the first T. The second T is technicals. Everything from the grades of this, the fact that it's smothered in infrastructure. We've got highways and gas lines and airports and townships all around us. The financial models as well. It produces great returns. So the whole technical piece wrapped around this, it's very, very supportive of the Fast Pathway project. And that's the second T. And the third T is team. As I continually say, I've amassed a team of people that have got thousands and thousands of years of construction operations experience that are with me on this project. But a lot of us have worked together before on many past projects and successfully delivered. So they know what they're doing. They're a fantastic A-grade team, and they're here to push this thing over the line, hence why the project execution is going so well. So they're the 3 T's, the thematics, the technicals, and the team.
Excellent stuff, Tony. Thanks for coming on. I know it's quite late. Well, it's getting late out there in Australia, and I know you're busy, so thanks very much. And hopefully we'll catch up in the not-too-distant future. Thanks very much.
Absolutely. Thanks for the opportunity, Justin.
The Vox Markets Podcast with Justin Waite.
And joining me on the podcast right now is Harvey Sinclair, CEO of eEnergy. Ticker there's EAAS. Harvey, thanks for joining me.
Good morning, Justin.
Yeah, and you're keeping busy and, sticking to the plan there. You've released an RNS, proposed acquisition of Beond Group, and we'll dig into that in a bit. But as always, Harvey, if someone's listening, they're not quite familiar with eEnergy, could you explain what it's about, please?
Sure, yeah. So eEnergy is an energy services business. Our existing core business is an energy efficiency as a service company. We transition our clients to reduce energy spend through LED lighting, which we do through a monthly subscription fee. So our customers are unlocking cash and reducing their energy spend without deploying their own capital.
Excellent stuff. Okay, and the proposed acquisition of Beond Group. So tell us about Beond. What do they do then, Harvey?
Sure. So if you recall, when we came to the market in January, we set out our strategy to be an integrated energy services company, and building on our energy as a service solution. At the center of our proposed strategy was the desire to get into an energy management business and acquire effectively the various products and services that energy management companies offer. So we've been in the market for a number of months looking, and we found an absolute cracker of an acquisition. We're acquiring Beond, which is one of the top 15 energy management businesses in the UK, and they're really differentiated by their position as a climate action business. Mm-hmm. So they are very focused on driving their customers to a journey for net zero. And they are also differentiated by the fact they have their own proprietary energy procurement platform. And they offer their customers effectively reverse auction solutions to be able to acquire the best possible energy contracts.
Yeah. And take us into the detail, if you could, a little bit more about the acquisition itself. How's it working out?
Yeah, so look, this is a business that we're expecting to deliver 800,000 of earnings for next year. We're valuing the business at 8 million. The vendors are taking 75% of the consideration as paper into the eEnergy group stock, so 25% cash consideration. The key management team are staying with the business. They're going to be pivotal in driving our group strategy going forward in the energy management space. So yeah, look, it's a fantastic deal, and we're really excited about this being sort of the first platform play that will enable us to grow as an integrated services offering.
Yeah, and like you said, it fits in. Like you said, you've previously talked about the strategy, and this fits in quite nicely, doesn't it?
Yeah, look, it's a fantastic business. It's a 20-year-old company with a great track record. They've been growing at 17% compound annual growth for the last 10 years. They've got over 800 customers, most of which sit within a very large sector with eLight, so lots of public sector customers. They've got multi-site corporate customers, education customers, so very, very synergistic. We've looked at their 800 customers, and we can see that there's immense synergies for eLight to be able to sell and cross-sell into their customer base energy reduction solutions through lighting. And likewise, Beond will be picking up our customer base to sell into them green energy procurement solutions.
Marvellous stuff. Okay, well, Harvey, I'm sure you're moving forward. The momentum's good. If people are listening to this and like the sound of this and not yet following the story, just if you could, in summary, give them 3 reasons why they should hit that follow button on your page and add eEnergy to their watch list, please.
Sure. So I think eEnergy is now positioning itself as a clear climate action business, and I think this provides investors with an opportunity to, get involved with a business that's really growing both organically and through accretive acquisitions. And we're going to be carving out our position in the market as, the one-stop shop for customers and businesses looking to drive their energy strategy to net zero through either green procurement or energy management solutions, whether that's reducing their spend through lighting, heating, and eventually getting to energy independence through solar and EV charging.
Marvellous stuff. Yeah, big market there, big potential. Harvey, thanks for the update, and hopefully we'll be catching up in the not-too-distant future. Thanks very much.
Thank you, Justin.
The Vox Markets Podcast with Justin Waite.
And joining me on the podcast and live on video, it's Paul Hill, equity investor, full-time analyst, equity, full-time everything. He's full-time, he's full-on. Paul Full-on Hill.
Yeah, morning, Justin. Excellent introduction.
You are quite full-on, though. You've got a lot of energy. And
coming from a man like you.
No, I got a lot of energy. So, do you have downtimes, though? I've never seen you have a downtime, a low-energy day. Do you sometimes... Wait, because sometimes I do have enough of stocks and shares sometimes. I wake up and I think, do you know, if you have a bad day or bad week in the markets, and you lose a bit of enthusiasm, it comes back quite quickly. But I do ever have those days where you think, do you know what? I'm not into this today.
No, I don't know, actually. I don't have that very often.
That's a condition.
I think it's a drug.
I know, that's a condition you've got there.
I think it's an addiction.
Yeah. No, do you know what? I'm never not into it. I don't know why. No, sometimes when you something doesn't go to plan, do you sometimes look at it and think, maybe what I'm doing is wrong? Even though, I've had years of sort of doing quite well in the markets, I often question, I suppose it's a good thing, having a company as a loss, is it good to reevaluate your plan, do you think?
Oh, yeah, I do it all the time. I mean, when it comes to sort of questioning yourself, I mean, one of my biggest actual, should we say, not problems, but issues, is that I actually do sort of like beat myself up, perhaps sometimes a bit too hard about the good decisions. But I need to go through the pain to be able to sort of cleanse it out and learn and take the lessons. And, it can take some time. But, yeah, I think you really do need to sort of reset the bar and have a good look at what you've done if you've made mistakes. Because if you don't do that and have a hard look at your decisions, then you're never going to improve.
Yeah. And... and I've got a filter, but I also always adjust it. It's like, every now and again you make a mistake, And I think I've always said it's quite easy to make rules. It's a lot harder to stick to them, and because it's quite an emotional game. When you're dealing with money, it's very emotional, because of course money is pretty much, it's how you live your life. If you haven't got money, it lessens your options. If you get less money, you have.
Yeah.
So it's quite an emotional thing. I often find all mistakes I tend to make are emotional ones. They're ones that I haven't written down. I write down the rules in the cold light of day, and they make a lot of sense. And then all of a sudden, I break one of those rules blatantly, and I make an excuse about it to myself. And I think, why did I do that? And it comes and bites me on the backside,
What did you make of the news this morning from Salt Lake Potash with the big fundraise? Because it was a tremendous amount of money they raised. Are you going to put some cash into the placing?
No, because this is what I'm talking about. Tony's on the podcast today, and one of the questions I'm going to ask him is: last time he came on, he said he had no more plans to fundraise, fully funded to Lake Way production, and one of the questions was, well, so what's changed? What's happened? And
he only raised $200 million.
Yeah, a while back, but no, this time it's 50 million. So, but there was
130 million US dollars of debt, wasn't there?
Yeah, so that's for the financial close. This is what it's saying. Do you know one of my filters now? And I will look at this is basically avoiding resource stocks that need debt and avoid debt pretty much. And whenever debt comes involved, it gets very complicated, And even I'm reading through that document, and there's several conditions that have to be met, and it's like that. It's like I remember Warren Buffett saying, investing is not like Olympic diving. You don't get points for difficulty. Keep it as simple as you can, because there's enough risk out there as it is. You don't need to invest in companies with debt. You don't need to.
Can I make a recommendation, actually, Justin?
Yeah.
6 weeks ago, you gave me a really big hard time for bringing up boring debt markets and loan markets. Have a look at the debt market and see whether on the small cap sector, whether it's expensive or not. And it still is. If you look at the actual leverage they took on Salt Lake Potash, it was 9% debt, plus they had an arrangement fee of, I think it was about 2.75, and then they've got unutilized facilities of 2. That ain't cheap. But
that's what I'm saying. Even though the EBITDA figures are very good and all that stuff, that's what I'm saying. In my mind, I like to keep it simple. And when you get debt involved, like you say, there's all these structures, and you've got to learn about debt then. In fact,
you have to.
No, I don't, though. Do you know what? I've done quite well without even knowing anything about debt or the debt markets. And do you know what? I'm going to stay away from it because I don't need to. It's just an extra level of spreadsheetery that I don't need. It's just. You don't have to. There are plenty of companies out there that don't have any debt. I think I fall into the Sado camp then in that case, because I get quite a thrill of sort of understanding the debt side as well as the equity capital. Yeah, no. All I like, this is as simple as that. I want a company, right? And these are part of my filters. A company with IP, pretty much. They've got a patent or protected IP. They've got big growth markets out there that are commercial, that are trending up. That are getting bigger and bigger. And they have a good product of some way, and they got good growth. And that's what I pretty much like. And they've got all of a sudden they've got funding. They've raised enough money to get them through the next level where they will be cash generative. That's what I'm looking for. Those kind of things. And,
can I give you a second recommendation then?
Go on. No debt. Right now, in bold, I've just added it this week. On my filter list, I've added in the liquidity part, because my filter forms an acronym called schedules, and the L is for liquidity. And I said, avoid debt. You don't need to look at companies with debt. You don't need to.
Well, I had a seminal moment. The reason why I raise it is because, and I've talked about it sometimes, I'm an investor in Northbridge Industrial. They came out with a trading statement this week, and I actually interviewed the CEO, Eric Hook, okay? And I've been following this business for a couple of years, 2 or 3 years, and I've put a reasonable size, full position in there, etc. But I strongly recommend you and any other investors have a look at this video, because I started smelling the coffee, and I am now even more excited about the actual company. And the reason is, and this is what next year, one step back, the shares were trading at 155 at the start of the year, and they had expectations of a 2020, etc., to grow. The actual results from their trading update are going to be about the same, flat on what they exited 2019, and the shares are 85p. Now, the interesting bit is actually as they go into 2021, they could have a much, much stronger 2021 than they'd ever envisage of having into 2020, and the shares are half the price. Yeah. And the reason is why they got growth, and this is the interesting bit that people should have a good look at, etc. Is that they've got three big growth drivers. First of all, they've got a huge amount of pent-up demand coming through the pipe through delayed projects. They've got extra big events happening like the Olympics, and their number one division is Swiericzuk, which makes and rents out, but importantly rents out load banks which test power supplies, as in temporary power supplies and backup power supplies. And the biggest driver, the long term, this is what I'm really excited about, is that the world from COVID has done two things, okay? It's become more digitized and it wants to continue with decarbonisation, okay? Which means we're going to have more green energy and renewables, okay? Yeah. Now, the problem with green energy and renewables, as you rightly know, when it doesn't flipping blow a breeze, the wind farm stops, okay? Now, the UK has been replacing steadily its base load. And I used to be electrical engineering. Just watch my hands here, okay? Yeah. When I was doing electrical engineering...
If you listen to the podcast, his hand's halfway up the screen. Go on.
Oh, sorry. Good point. Yeah. Okay. When I studied electrical engineering, base load was about 85%, okay? It's now significantly below because essentially all the coal has been taken out of circulation. And what you get during a day, you get a peak in demand. And the only way they're servicing that currently is through gas, okay? And they've got renewables. Now, the problem they have, and this is, do you remember, crash you back 12 months ago, and there was a huge blackout in the east of England. The whole of London went down, hospitals and the railway stations and everything all disappeared. They didn't have any power, And the reason was because that peak power surge, they had simultaneously, the wind wasn't blowing and one of the gas turbines went offline, meaning the half of the country went down. So what you're saying here, because you're putting on more intermittent temporary power into a massive grid, a massive network, it's becoming more unstable, which says two things, okay? If you have a mission critical activity like a hospital, like a data center, like it's a business, like a Sainsbury's, you need power supplies, whether that is going to be
stable power supplies,
a battery farm of your own, to power in when the network goes off, or alternatively uninterruptible power supply, which again is another type of backup power, temporary power supply. Every single one of those needs to be tested and needs to be serviced by a load bank. Who is in the number one position? And Swiericzuk is probably the biggest brand in Europe for load banks and testing. Now, that is exciting if nothing else. But what's even more exciting, and this is why Eric, and I didn't realise this at all, it's a fascinating interview, okay? The drop-through rates on hiring load banks is 85%. Every pound of turnover you do, you get 85 dropping down to the bottom line. This is going to be, the next 10 years, if we move to a decarbonised future with more renewables, more solar, more wind, the network as a base is going to become more unstable because you can't manage those peak and troughs as easily. So occasionally, like when you really tighten a rubber band, it breaks. Because of that, and because the world needs power to run online, digitization, cyber defense, hospitals, fire stations, even your basically your robot dog, will need power, You can't go for a walk if it doesn't have power. And on that basis, you will need battery power. And they are in the number one position to be able to test those. Now, even better, and this is what I did not read, and I've been following this stock for 2 years, okay? Their other division, Tasman, which does now gas and geothermal drilling tools, okay? In Australia, as you probably know.
Can I just say that? That's what, the thing is, the load testing, the load banks. This is what confuses me. See, I like a one-story stock. Keep it simple. And this, to me, if one is really going to take off, because I don't believe you have two parts of the business that are going to both be mega busters. Are they going to get rid of one part?
You were the same skeptic like I was. Okay, I always thought Tasman and Swiericzuk had zero synergy value. Okay. And therefore, the Swiericzuk is a fabulous business. In my view, it's worth at least £1.50 on its own. Shares are currently 85, blah, blah, blah. But this is the beauty when you speak to these guys. They give you nuggets of information that actually just transform your view. And this is what I'm saying with Tasman, okay? in Australia, they are one of the most, they're not quite like Scandinavia, but they're moving towards a more environmentally friendly society because of all those wildfires, if you remember, yeah? Like over Christmas, everything was burning, right? Yeah. But they've got massive reserves of natural gas. Now, we know natural gas is far more carbon reduction or reduction measure than coal or anything like that. And the government want to use it. But what they're doing is they're actually going to make blue hydrogen. Now, I'm not talking about a triple X rated film here. This is not what you watch on a...
I've seen that before.
Blue hydrogen is the way they burn natural gas, go through the electrolysis to create, effectively burn natural gas, create electrolysis, and through electrolysis and create hydrogen. And when they store hydrogen, the hydrogen is then used as an energy store and then gets converted by effectively a power supply, and the power supply then has to be will be maintained by like the Swiericzuk, etc. But Tasman have got big contracts to already do all the carbon capture from that blue hydrogen burn and inject it into caverns down in Australia, so it becomes green. So you've got blue hydrogen that's turning to green hydrogen because you're burning natural gas and inject it into carbon capture. And that's what Tasman's going to be doing and is already doing in Australia. I'll tell you, these two businesses now have a real connection because they both reduce the carbon footprint of the world and keep the lights on, which is
listen, I'm looking for exposure to these things. A couple of questions then. Do they have debt?
They do, and they have net debt of about 2 mil. But they in COVID, during this year, they've actually reduced their debt, as in like they've actually generated cash, even in a really sort of flat year. I mean, with operating leverage, they've got no problem with their debt. Yeah, what they do have is convertible loans, and they need to they're not having to refinance that, but basically they turn into equity. But if you assume, and I am absolutely assuming they're all going to go into equity, then I still believe these shares are worth a minimum £1.70, £1.75, which is my fair value.
What's the price now?
85p.
Oh yeah. And one other thing, are they loss making at the moment? Are they?
No, they've just basically moved into their PBT. They said they were going to be profitable for this year in COVID, which actually is very much in line with where they were. You'll start seeing they've hit a turning point. They have hit, in my view, a turning point. And the operating leverage when it comes through, because of Tasman, it's about, again, Eric, told me, basically it's about 65% for Tasman and 85% for Swiericzuk. I mean, they fit really quite well, actually. I mean, I was quite a skeptic, but I think they're because of this blue hydrogen link, with one of them actually being used for carbon capture, then you get that conversion in that sort of like intermediary into green hydrogen. But Swiericzuk is a fabulous business in my view. Absolutely, it's in a perfect sweet spot, and it will get. If you just think about the Olympics next year, you've got pent up demand, and then you've got the Olympics, and the Olympics. They've hired all their big contract for temporary power is with Agrico, and that's all out in Japan. And they service all the Agrico stuff, i.e. for their temporary powers. Not in Japan, they won't do it, but because of that'll create huge amounts of demand elsewhere because the Agrico stuff, the fleet has gone elsewhere. So global demand will increase. I mean, they've started knocking the ball out in California. And you can understand why, because they've had wildfires last year.
Yeah. And let's be honest, I mean, at the moment, I don't think we're going to see any trend bigger than the trend towards clean energy, EVs, and all that ever in our lifetime. I mean, I would say every government in the world, now banned petrol, diesel cars, pretty much. And so any exposure to this, side of the is going to rise.
And digitisation, so it's decarbonisation and digitisation, because you've got two trends, yeah? You've got basically the renewables is reducing the base load of the network, which is making it more unstable, and you've got the tolerance of society to power outages far less than it's ever been, because it's dependent. It's critical. It's not become just critical for a hospital. It's become critical for me and you to do this webcast, It's going to be critical for everybody else in the world to do.
Yeah, some people wouldn't mind a blackout on us too. I think. There we are.
Well, Amazon would be a bit annoyed, I think.
Yeah. No, exactly. No, I like that a lot. I mean, I'm watching, and they had a bit of a sell-off, didn't they, in March? They were at 160.
Yeah.
160. They come down to 70 pence. Now they're at 86 pence. They've rallied a little bit, but they haven't, gone back to.
Yeah. No, and just comes back to your point where you question yourself. Yeah. Equally, what you get is occasionally you get extra bits of information that put all the pieces together, i.e. such you become even more I've been looking at this for ages, but I did not see this blue hydrogen link between Tasman and Swiericzuk, and I didn't appreciate as much of how unstable the Western networks are getting because they're putting so much renewables on, and it's going to happen more and more. And if you've got...
Good. No, I like it. NBI, Northbridge, cool. Have a look at that. One for your watch list there. Anything else? We've got limited time.
Okay. I'll just quickly breeze through. You spoke to Tim Sykes. I thought, they had a breakthrough contract for their Accelerate. This is Proactis. We had a breakthrough contract for their Paid accelerated payment platform for small purchases. That could be very seminal in my view. Again, the runway on that is significant. So, again, the shares are beaten up. It does have debt, but it generates a shed load of cash. EBITDA margins are very good. Drop-through rates, software. It's basically SaaS. It's 90% SaaS. So, that's one which is recovering. And it's gone up from 32 to 42, and I could see it go. My fair value for that is, I don't own the shares, but I could see that run to 150. No problems at all if it, continues up the way it is. Another one which is worth, came out with a decent trading update was Kromek, actually, because they're saying they've had a really tough COVID because of all their three markets have been absolutely hammered.
Who is this?
Is medical screening, defence, and
Kromek, Kromek,
and Homeland Security and airports and stuff. So it's all been but they're all now coming back. They came out with a positive trading update. And what they also said was that they've just got 2 contract extensions for their D3S dirty bomb detector, mobile dirty bomb detector in Europe, because they've got that big contract out in Washington, New York on the East Coast. Now they're actually getting significant interest into Europe, and they talked about they've already, it's got that particular contract. That customer's gone to 2.5 million. It looks as though they wouldn't be spending that kind of money unless it was going to happen. Any of these contracts, if they drop through, could be millions on their own. So that's another one which is worth having a look. Yeah. And just generally on the market, we've seen a wobble because of Brexit. Don't get fazed by it. This is going to be a non-event. And the other key, big picture...
Why do you say that?
Brexit, okay. Because there's masses of capacity at the ports. Tourists are travelling over the Christmas period to Europe, etc. Okay, so what the market is getting a bit concerned about is obviously the tariffs. We're going to if we have to go to Australia, tariffs, who cares? It's only it doesn't really matter. We'll get it sorted out. And what will happen is they'll throw handbags at each other, and then they'll probably agree a deal in January anyway. I'm not.
Well, the thing is, what we get though is stories. there are certain areas, and they're like cars, for example, extra 10%. It'll go on certain cars. There's certain areas of dairy they've got like 35%. Of course, effects, currency effects will change probably. The pound will probably get weaker anyway, so it'll be okay. But but I think there will be certain industries, and I think a deal will get done. At the end of the day, because like I said,
yes.
What I hated on a political level, what I hated Boris saying is like more like an Australian deal. Why did he just say it's a no deal? It's not relevant for Australia. We don't exist over the other side of the world. Australia's biggest trading partner is China. It's not the EU. We export 43% to the EU, 43% of our exports are EU, and 52% this way. So it means a lot to us. So he can't just say it's like more like an Australia deal to soften the blow. He should just say it's a no deal. But I think it will get sorted because there'll be pain on both sides. So
exactly, yeah. Look at Germany. They're the biggest car manufacturer in Europe.
Yeah.
We're their second biggest market. There's no way they want to wreck their exports to the UK by having a 10% tariff on their BMWs, Mercedes, and Volkswagens, is it? So
exactly. Look at all the cars they got. Amazing engineers, and they BM, Audi, Mercedes, all that.
Yeah, and what the big picture, or the thing to take away from it, when you see wobbles on the market because of fears, etc., always put in your own mind as you're an investor, this is the market on a daily basis just trades a very small fraction of investors' opinion. Most investors, 95%, 98%, are absolutely comfortable with it. All you see the transactions happening is the 1 or 2%. And it's because it's a market, that's how markets work. It can have swings, but overall, the actual vote of all the investors is we're going to hold and we're happy with it. It's only what you're seeing is just the 1 or 2%. It doesn't mean the value of the shares has gone down. It hasn't. The value hasn't. The price has gone down, but the value hasn't. And most investors still believe we're going to be absolutely fine. Always just look at the movement in the shares, and it's usually very small. And it's not indicative of what.
I'd be worried if I had 80% of my stock was exposed to dairy products. But if I look at my portfolio, I got no exposure really to the Brexit problem, the trade deals, the problems with tariffs. Nothing's going to affect my portfolio really at that. So that's what people are going to look at. Look at your own portfolio. Is it going to get affected really? Apart from the sentiment, and the worry, and the press, and the media speculation, actually look at the fundamentals. Is it going to affect
exactly
any?
Right.
You're
spot on there. Concentrate on value rather than price. And that's how Buffett does it.
Marvellous stuff, Paul. Thanks for that. And if you like the video of this, by all means, hit that subscribe button and notification bell, and you get the next one to your inbox. Paul, right to your inbox. Straight in there. Cheers, buddy.
Thanks very much, Justin. Have a good weekend.
The Vox Markets Podcast with Justin Waite.
And joining me on the podcast right now is Russ Mould, Investment Director at stockbroker AJ Bell. You all right, Russ?
Yeah, good health and pleased to say, Justin. Hope you and the family are okay.
Yeah, all good. And
good.
It's good news. Do you know what? It's funny. We, UK, the first. I knew Boris would have to do something to say we haven't messed something up. We'll do but a lot of people say maybe you shouldn't be the first at rolling out a vaccine because time is very important with vaccines, isn't it? But I suppose it's showing safety. But what's your thoughts? I mean, I've seen a lot of people say, "Well, I wouldn't sort of rush towards having it." And are you the same?
I'm a little bit because I'm allergic to penicillin, so I know you've got to be a little bit careful in terms of the allergies, and they've warned about that. And also, certainly, the Pfizer Moderna, the Pfizer BioNTech treatment is based on a new approach whereby you don't actually inject a mild version of the illness into the body, then stimulate the antibodies. You actually sort of convince the body that it's there already, and then persuade the body to respond accordingly. So it's a different approach. It's a bit new. It's been done. It has been done in a hurry. It's been a phenomenal achievement to get it out. I guess personally, I'd be a little bit wary on the safety front myself. But I guess one of the things that may slightly, encourage some thought is, what happens if you have to have this sort of digital passport, or say, have you had the vaccine or not, if you're allowed to go anywhere or do something. So I think that's going to be potentially an issue for people to address in 2021 and beyond. I mean, it isn't easy to get these things right. We've seen this morning, the Australians have canned their development project, and GlaxoSmithKline Sanofi. I mean, Glaxo is the world's biggest maker and distributor of vaccines. 2 million vaccines a day provides worldwide, and they've encountered a disappointing response with their phase 2 trial, so their drug now isn't going to be ready until the end of 2021. Intriguingly.
Really? I didn't see that.
It's just come out this morning.
Do you know what I was looking at though? I'm thinking from an economic standpoint. I was thinking we only need, if you look at it, if you break it down, the economy is in lockdown to protect the NHS now from being overwhelmed. And these are people, and these people who are overwhelming the NHS are largely, people with pre-existing health conditions or above a certain age. Now, if you look at that category of people, there's 2.5 million in that most vulnerable category. And then there's 1.4 million who work for the NHS. There's about 1.1 million care workers. That's 5 million people, right? So if you vaccinate all those, which is 10 million doses, we've already ordered 40 million from Pfizer. So then that will relieve the pressure on the NHS. And from an economic standpoint, we won't have to lock down. Of course, people will still contract it. A lot of people will be asymptomatic, I assume, because that's what's happened. And a lot of people, it won't be more than the cold or flu. So that's surely around 10 million doses or 5 million people being vaccinated. Those vulnerable people will help us going forward.
That would help a lot. And also, I mean, I'm 51. I think, in theory, I'm offered a flu jab this year. I've looked for it in my hometown of Brighton, and actually, there are any to be had at the minute, intriguingly. But I think it's basically up to about the age of 70. the current survival rate is 99.7% or something. So I think the odds are relatively in your favour.
Yeah, exactly.
And yet, even if you've been unlucky enough to lose a loved one who's been over 70 years old, the survival rate then is still 96%. And as you say, it's unfortunately the disease has been very cruel to people who've had an existing precondition, unfortunately. So I think overall, your chances are still pretty good. But as you say, if you can get the treatment safely to those who need it the most, then you would like to think, if the danger of the NHS being swamped is taken away, that might give the government a little bit more leeway on the economic side of things. Fingers crossed.
Yeah. What's odd is that we are in this sort of like America at the moment. They had yesterday, I don't know if it was a record amount of deaths.
The numbers are big, yeah.
And I looked at, I was watching CNN, I think it was, and they were saying, if you go back in American history, there's only 2 other days when they've seen as many losses of life. And that was one is a massive hurricane, 100 years ago, and one was a civil war or something. So, and they're saying that it may even surpass that in the next couple of days. And yet the markets are riding high, stimulus packages and all this stuff. And we got Airbnb floating yesterday worth about 100 billion. And I did see someone saying, I've never used Airbnb, and have you used it? Yeah,
I have. Yeah, it was dead easy actually. We stayed in a lovely big townhouse in Oxford, and the lady and the chap who had this big townhouse looked after us really well. The rooms were comfy, and it was dead easy. And frankly, hotels in Oxford are just the wrong price.
Yeah.
You want to go for a weekend, you've got to stay for a minimum of 2 nights, and so it actually gets to be a bit of an expensive gig. So we took the Airbnb route, and it was an absolute doddle. I have to say it was very straightforward.
So that plays out. What about the valuation of Airbnb? Is that as comfortable?
Well, this is the tricky bit, right? I mean, it's now apparently it's got a higher market cap than Marriott, which is the world's biggest hotel chain. So Airbnb's market cap is about $80 billion. This is for a business that last year, lest us not forget, lost $500 million on $5 billion of sales. Wow. So you're paying, 16, 17 times historic sales for a loss-making company. Now, I know it made a profit in Q3, which I think has got everybody very excited. I think that was, sort of the dash out of the first lockdowns. There was a lot of staycationing going on. So it shows what the business can do. And I think you've got this intriguing overlay with a story of some people seeing it as a big cyclical recovery play for 2021 and beyond, as we're all hopefully given a little bit more leeway and we're all feel able and safe enough to get out there, or are allowed to. And you've got other people saying, well, actually, this is a long-term growth story, a disruptor of the hotel industry that is, going to be a secular growth play. So you've got sort of overlapping stories. I think what's intriguing there is that it's not priced to be a cyclical recovery play on 17 times historic sales. You can buy bombed out cyclical stocks in the UK on buttons, low multiples of peak earnings or normalised earnings, let alone sales. And the secular growth thing, well, we've talked about this before, value or cyclical growth has been outperforming growth or sort of tech secular growth since July. I know that process has accelerated since Pfizer Monday in November, but value has been outperforming growth for nearly 6 months now. And although some people think that trade's kind of tired and a bit fagged out, if you look at it in 2000, the violence of the move from growth to value was phenomenal. And if that trend continues or accelerates, it will catch a lot of people out. Now, I'm not saying that means that tech stocks are going to collapse, but it means that value and cyclicals, if we really do get a recovery because of the reasons you've outlined, we manage to shield the most vulnerable, protect them, and let everybody else hopefully give them the confidence to get out there and go about their business again. I just, under that circumstance, you just don't need to pay 17 times sales to get hold of fantastic earnings growth. You'll be able to pay much lower multiples for companies that are genuinely making money and doing it in a hurry and recovering very quickly. So I am a little bit worried about Airbnb, that there's a bit of the element of a fear of missing out, and markets are generally the most dangerous when making money looks easiest, right? Which is kind of, the thing was going to be priced at $44, then $54, then $68, and now it's traded up to $144. So if you'd have said to me in March, well, its valuation is going to sort of treble during a pandemic, I'd have looked at you and gone, really? But I guess on the other side, what you have got is, you've got a potentially interesting growth story, and you've got lots and lots of money sloshing around with interest rates at zero QE, and the Fed is openly saying, we want to let the economy run hot, we want to let inflation run hot, and we're going to let the markets run hot. And in that respect, you can see why people are piling in. So for me, it's probably more of a market melt-up bet I think it's it's a dead easy platform to use, and I get it. But I just think a market cap of $86 billion for a loss-making company, 17 times historic, so there's just a heck of a lot in the window there, or in the shop window there already, and it just doesn't appeal to me. My style of investment, I'm afraid to say, but I didn't think it would get to where it's got, where it started at 68, let alone get to 144. So people might think, well, I'm a bit of a fuddy-duddy and I should push off. But we are getting to that stage when it feels to me like we're starting to say valuation doesn't matter, it's different this time. And those are usually dangerous waters.
Yeah. And also, I think an IPO, when, of course, you've got all the companies, brokers, PR, media, giving it the big one, getting maximum publicity, that is generally not a good time to buy a stock, I think. It can go on further and go higher, of course, but in my mind, the best time to buy is when everything's a bit quiet, and people forget about it a bit,
That's my personal preference. Yeah. And I think if you can say, look, it was priced at 68 and it's gone to 144, either our good friends at Goldman Sachs made a mess of pricing the thing, or investors have lost their marbles.
Yeah.
I mean, you pays your money, you takes your choice. I know that investment bankers having been there and done it myself for a different bank, you try and structure the deal so there's something left on the table for the investors and create a strong aftermarket. Nobody wants a deal that doesn't trade above the offer price and just goes down, which is kind of what Uber did. But equally, I think if you were the bankers and you've seen the thing double on you, you go, maybe we didn't quite get that one right. But equally, even there, it was still on 8 times historic sales for a loss-making business that's got a very finite profitability history. I think they gave it a pretty good go, frankly, and I'd love to see what discounted cash flow assumptions people are making in terms of long-term margins and terminal growth rates and cost of capital to justify a market cap of $80-odd billion. I'd be absolutely fascinated to do it there, but I bet they're pretty optimistic.
Yeah. It's funny, Uber, it came to the market, really, they're different from other companies because they had all these moonshots as well, like the taxis, self-driving cars. This week, have you seen Uber selling them off? They sold off the taxis,
the air taxis,
and the air taxis, So now they're heading towards profitability, which is like, okay, you forgot about that. You can't balance like a normal company. They've turned a sensible corner here, it seems, and they are heading towards, or trying to head towards a bit of profitability, which is a good thing.
Yeah, I think Uber's, again, 10 out of 10 for ambition. I think they were trying to do too many things at once.
Yeah.
And, if they were focusing on being really, really good at one thing, I think they'd have had a chance of making a lot more money, a lot more. I understand that there's potential there. But this optionality concept again. Oh well, you're getting the business, but look at all these other things it might do, and but that's fairy stories. I mean, it's a little bit like Tesla. I know that it's again a controversial stock in that let's face it, making cars isn't a great business, right? It's 8% operating margin if you're lucky. It's brutally competitive. There's but Musk is saying actually, well, it's not that. It's because we're going to be an intellectual property. We're going to license out and do it. And again, we're going to have self-driving cars and trucks and fine. I get it, but again, with its market cap at $600 billion.
Yeah.
I think that's pretty much all of the global car companies put together. Except again, there's an awful lot in there. And coming from a bloke who I hope he succeeds, but this is the man who was 18 months ago saying, well, we won't need to raise money. Forget it. And they've actually done 3 raisings in the last 18 months. It's, that path again has not been as straightforward as people had assumed. I know the pandemic's complicated matters massively, but nevertheless, that company is still sucking up cash by and large, and the profits it's making is from selling its carbon credits, not from making cars.
Yeah, exactly. And so where now, Russ, is the $1 million question? What sectors would you be looking amongst right now if you're thinking, okay, the economy is turning back to normal here, maybe in the next 3 to 6 months, what would you be looking at?
Well, I mean, we talked about it a couple of months ago. And there was a bit of rhubarb, I think, on Twitter about it, and some pushback from customers of my company. The one that we talked about was oil. And a lot of people push back on it because they say, well, it's evil, it's horrid, it's wicked. And I said, look, I completely understand the ethical considerations, but believe me, we're still going to be using it in 5 and 10 years' time.
Yeah.
And, these stocks, they were washed out. Sentiment was completely against them. Oil was on its back. And, since we last talked about it, they're up, 30%, those companies? Yeah. And oil's back above $50. So and that's not me being clever, trying to be smart. It's just me saying, look, sentiment was so washed out, it would take nothing to get those stocks to surprise on the upside. And I still think that's, to a degree, the case now. I think house builders are still cheap. Some of them still trade at book value or less. I know that you've got Brexit and worries and so on, but I still think they're cheap. Yeah. So I think that they would intrigue me. The builders merchants, I think, are still in a good position. So, and I hate to say it, but I think for a punt, if you think there is a recovery coming, then the banks are probably a place to look because they trade at big discounts to book back. I think structurally, long term, they've got horrid problems. They're boxed in by regulators. Their customers are still hacked off with them for what happened 12 years ago, and they've got fintech not even nibbling away at them anymore, but positively biting lumps out of them. So I think in that, and I think now that you can see the government increasingly using them as tools of policy, government guarantee loans, put it here, so the debt doesn't go on the government's balance sheet, it goes on the bank's balance sheet. That's a bad place to find yourself. So there is a risk that they're being increasingly used as tools. So all of those things make me think long term, banks not a good place to be. But it doesn't mean that if you're of that type of investment philosophy, that there might be stocks to rent rather than to own. But again, as somebody who believes in long-term investing, I would probably do it myself. But if you fancy it, even the Japanese banks have had huge rallies, and they're down 90% from their peak in 1989. Wow. But there've been some whacking great rallies there when people think the Japanese economy is going, and when they think finally interest rates will go up and the yield curve will go up sustainably. I mean, let's face it, interest rates aren't going up quickly here in the UK or indeed anywhere else in the Western developed world. So that's a margin crusher for banks anyway, which is why, again, I think they've got structural problems. But there will be times the market thinks we're off to the races, and that's when you might want to rent these stocks. And they've moved a fair way this autumn. And they're now being allowed to pay dividends again by the PRA. Yeah. So in theory, they're on a 4 and a bit% yield next year. There would be a punt rather than actually. I think there's like house building. There's just supply is just below demand. Full stop. That seems like a pretty good place to start to me. Whereas banks, multiple problems on multiple fronts, and I think they would therefore just be a punt for me. Yeah, exactly. I mean, if you look at it like Lloyds, for example, they are the worst performing sector over the last 10 years. Oil is the second worst, so that's where I'd start nibbling about just because. Yeah, if you look at, for example, Lloyds, the chart there, it shot up on that big sort of day when Pfizer came out with the vaccine a couple of weeks back, and it went from like 27 pence up to 40 pence, topped out there. Now it's rolling back over now, and we've had a couple of down days down at 34 pence. But again, I think we'll have these times where we'll have this euphoric rises where we're getting back to normal, and then you realise it's going to take a bit longer than we think, actually. Yeah. And so you'll have this up and down. So again, buy low, I suppose. It's nibble away when people are losing a bit of confidence and they're on their softer. Like the house builders, they have a huge run. They're just coming off a little bit. Again, that's the sort of day I'd be tempted, because that's when the valuation's lower, and therefore you've got more downside protection and hopefully a bit more upside potential at the same time. Yeah, excellent stuff. Russ, thanks very much for that, fella. Keep well. Okay, it's time for the top 5 most followed companies on Vox Markets in the last 24 hours. They are at 5, Infrastrata, up 3.5% to 50.2 pence. At 4, Braveheart Investment Group, down 20% to 18.5. At 3, Wishbone Gold, down 6.5 to 12.25. At 2, Helium 1, up 15% to 7.5. And at 1, it's Blue Star Capital, down 2.27% to 0.215. Had a good rise yesterday, though. Okay, top 5 most liked analysts are as follows. Deep Verge, new labs can service update. Shield Therapeutics, update US partnering discussions. At 3, Salt Lake Potash, funding and lifting of excess voluntary suspension. 2, Union Jack Oil, West Newton, B1Z drilling update. And at 1, Synergen Holdings, Polar Capital, they got up to 8.7% from 7.3. And let's have a look at the most read as well. Most read are Gene Drive, conversion of remaining notes, Deep Verge, Director Share Purchase, Vast, Remote Monitoring Systems, Farm to Farm Update, and Salt Lake Potash, fundraising and lifting of ASX voluntary suspension. Of course, I talked with Tony about that on the podcast earlier. Thanks very much for listening. Muchos apreciatos.
The Vox Markets Podcast with Justin Waite. Nothing in this podcast is intended as investment advice, and the people in this podcast may hold positions in the stocks they talk about. Do not buy anything based solely on a tip or recommendation. Please do your own research.